Welcome to video number 5, Transaction Analysis Basics. Let's look at our roadmap. Here we are in our accounting crash course now. We've talked about the introduction to the accounting process. Now we're going to talk about transactions that companies are doing and the basics of how to analyze these transactions. Okay, transaction analysis. First of all, what are transactions? Transactions are economic events that affect the accounts. So let me just back up here. Remember, accounting is keeping track of accounts, and the accounts are put together to represent the financial position and operating performance of a company on the balance sheet and income statement. So accounting is keeping track of accounts, okay? And we talked about the accounts in a previous video. Transactions now are economic events that affect the accounts. So below that bullet point, I have all of the different accounts that we learned about. If your company engages in a transaction that affects one of these accounts, well, then you have a transaction that you need to account for using journal entry, okay? So that's what a transaction is. All transactions that we analyze must affect at least 2 accounts. And this is just a force of nature, okay? This is cause and effect. If you receive something, the question is, well, where did you get it from? If you remove something, the question is, well, why did you remove it and where did it go? So to every transaction, there's going to be a cause and effect. Where did it come from and what did you do with it? Okay? So each transaction has 2 pieces to it. Sometimes you can get a little lost in space when you're confronted with a transaction and you don't exactly know which accounts or how this transaction will affect the accounts. This is just a suggested method that you might go through when you're confronted with a transaction. The easiest place to start is ask yourself, is cash involved in this transaction? And if it is, you're lucky because it becomes a lot easier. You just need to ask yourself, if cash is involved, is cash coming into the business or going out of the business? And then you know how to adjust the cash account of your business. So if cash is involved, it becomes pretty easy. If not, you need to do a bit of a brainstorming exercise. What accounts are affected by this transaction? Does this transaction increase or decrease an asset, a liability, an equity account, a revenue account, or an expense account? Remember, when you're done with your transaction analysis and you think you've identified at least 2 accounts that are affected, you need to make sure that your entry keeps the balance sheet in balance. So if you increase an asset, you have to realize that this equation is going to change, okay? And just like algebra, if you do something to an asset, you either need to reverse it or you need to increase a liability or equity account to keep the balance sheet in balance. So that's the last step you can go through when you're doing your transaction analysis. Let's again take a look at this slide, which kind of summarizes all the accounts we talked about in the 5 different categories that we've talked about: balance sheet and income statement. And remember this relationship. On the balance sheet, assets equals liabilities plus equity. And on the income statement, income minus expenses equals net income. Now, when we do our transaction analysis, if we do something to an income or expense account, what we're going to do is immediately assume that whatever we did to one of those accounts is going to flow into retained earnings. And that's one of the ways we're going to be able to make sure we keep our balance sheet in balance. So each time we analyze a transaction and decide that an income or expense account needs to increase or decrease, we're going to automatically assume that that transaction is going to flow through into the retained earnings account. So let me show you what I mean, and I'm just going to do a couple examples here of transaction analysis, and you can see how I'm keeping my balance sheet in balance by the end of each of these transactions. Let's consider one transaction where just one piece of it, accountants become aware of the fact that we've gained $1,000 worth of PP&E, okay? So what I've become aware of is that now I've got a new piece of equipment in my business that we paid $1,000 for. So now I have this asset called PP&E, which I know should go up by 1,000, okay? That's part of my transaction analysis. Here's a new piece of equipment, PP&E goes up by 1,000. But there needs to be another piece to this transaction, right? And the question is, well, how did this come into the office? Did we pay for it? How did this work? So one possibility is that we paid for it with cash. So in this case, the PP&E account is going up. We used cash to pay for it, so the cash needs to go down. And you can see, let's take a look at the end of each one of these. Let's make sure our balance sheet is in balance. You can see that when we combine these two transactions together, the effect on total assets is 0. And so the effect on assets is 0. There's no effect on liabilities or equity. And so our balance sheet equation stays in balance, and we're okay in terms of our transaction analysis. Now let's imagine a different scenario, which is rather than paying cash for the PP&E, as an accountant, you might say, hey, have we paid for this thing yet? And somebody might say, actually, we haven't paid for it yet. Then as an accountant, you say, well, we have an obligation to pay. And so an obligation to pay our suppliers is called accounts payable. So rather than paying cash at the moment, we're just going to increase our accounts payable balance to keep track of outside entities who we owe money. Now that we've done this, is our balance sheet in balance? Yeah, we've increased assets by 1,000 and liabilities by 1,000. So we've increased both sides of the equal sign, and our balance sheet is in balance. Let's talk about another transaction. Suppose we receive some cash. So that's the first thing we become aware of as an accountant. Hey, we received some cash in our bank account. The question is, where did it come from? Well, suppose it came from a customer who bought something in a previous period and they owed us money. And now they're finally settling what they owe us. They're paying us the $1,000 that they owed us. Well, we received the cash, so we increased our cash account. And now we're going to take them off of the list of people who owe us money. Remember, accounts receivable is just keeping track of people who owe us money, and we're taking that customer off the list. Does the balance sheet remain in balance? Yeah, because these asset transactions cancel each other out, and nothing happened to liabilities and equity, so our balance sheet stays in balance. Now suppose instead of being paid off by one of our customers, suppose instead that we're receiving a customer prepayment. So that guy on the computer putting his deposit in for a Rivian, that's the reason we got $1,000 in cash. Well, the accountants think, okay, that's great that we have the cash, but now also actually we have an obligation to deliver a car to this customer. So where do we keep track of obligations? We keep track of them in the liabilities. Remember, liability is an obligation to outlay resources with economic value, and we've got an obligation to deliver product to this customer. So we're increasing our obligations here by increasing the liability account called deferred revenue. Our balance sheet is in balance because we increased both sides of the equal sign by the same amount. Okay, instead of deferred revenue, suppose this cash is actually the company's borrowed money. So we've borrowed money from a financial institution or something like that. We've borrowed funds. That's called debt. We've got cash, but also we've got this obligation to repay the cash, many times with interest. But in this case, we're going to record a liability, which represents our obligation to pay back that $1,000. Balance sheet is in balance. Suppose alternatively, we got an equity investment. In that case, we would increase the contributed capital account. We received cash in return for ownership in our business. Does the balance sheet stay in balance? Yes, it does. We increased both sides of the equal sign by 1,000. And the last transaction, what else could an increase in cash be? Maybe we actually made a sale, okay? Maybe we actually sold something for $1,000. And so when we've earned amounts from our customers because we've delivered goods or services, that's considered revenue. So that is reflected on our statement of operating performance on the income statement as an increase to revenue, which will increase net income. Now, don't forget, every time you do a transaction to an income statement account, we have to assume it flows into retained earnings, right? So this is how that $1,000 of revenue is going to flow into retained earnings, and it will increase retained earnings. And that is why our balance sheet will stay in balance, because that revenue is going to increase our equity. At the same time, our cash is increased on the balance sheet, and our balance sheet stays in balance. Okay, the final example is going to be actually down here in the expense section. Let's suppose our employee has worked for us for a year, and they have earned $1,000 of wages. Now, I don't know whether we've paid for this or not. Suppose we haven't paid for it yet, or suppose we have paid for it. But before we talk about whether we've paid for it or not, I want to talk about what I've just revealed on the slide, which is this wage expense Expenses are going to reduce net income. You see this minus sign here, income minus expenses. So a reduction in net income is going to flow into retained earnings, and it's going to reduce retained earnings. Remember, income increases retained earnings and expenses decrease retained earnings. So that's how that expense will be reflected in equity as a reduction in retained earnings. Now let's go back and talk about, have we paid this employee yet? Suppose we have paid the employee. So this $1,000 of wage expense is also reflected as a $1,000 payment in cash, and that reduces our cash balance by $1,000. Our balance sheet stays in balance. We've reduced each side by 1,000. Another example that does happen is that you've worked for your company, but the company hasn't paid you yet. Have you ever had that experience? You've done your work, but you're still waiting for the pay period so your company pays you. Well, this is what it would look like on the company's balance sheet. They owe you money, okay? You've worked for them, so they owe you money. They've incurred the expense, so it shows up on their income statement as wage expense. It reduces their retained earnings because they have less net worth, because they have to pay you. That reduces from their net worth. But they haven't actually paid you yet, okay? They haven't had to pay any cash yet. They just need to keep track of the fact that they owe you money. And that's going to be in accounts payable, that they owe you $1,000. They're tracking it as a liability, their obligation to outlay an economic resource to you in the future. Is our balance sheet in balance? Yeah, because our liabilities went up by 1,000, our equity went down by 1,000. So these two effects cancel out. There's no effect on liabilities plus equity, and there's no effect on assets, and so our balance sheet remains in balance. So those are just some examples of transaction analysis, and we're going to do more examples in the next video. The next video, we're going to begin our exercise. It's a comprehensive exercise of a company, and we're going to do some transaction analysis of transactions for one of our made-up companies. So I'll see you in the next video of our accounting crash course.